Tonight, in this podcast, we explore the quiet walls we build around what we own and the deeply human instinct behind financial secrecy.
Yeah. It's something we all do, really.
It is. And, welcome to this deep dive. We're really glad you're here with us.
We are. It's a fascinating space to explore.
Right, because today's journey is, well, it's about looking at the actual mechanics of how we hide our resources. And I want to be really clear right up front. We are not here to judge the behavior.
Exactly. No judgment at all.
We just want to understand the human impulses that actually drive it.
Because those impulses are universal. I mean, they really are.
They absolutely are. So just to give a quick overview of what we're looking at today, our sources range from Global Financial Task Force reports on money laundering.
Which get incredibly complex.
No, dizzyingly complex. And we're pairing those with behavioral science studies from the University of Exeter and even some new international tax disclosure rules.
It's a really interesting mix of the macro and the micro.
Yeah, and our mission today is to kind of pull back the curtain on this concept called concealed beneficial ownership.
Which sounds very technical, I know.
No, it does, but we want to understand what happens in the mind, and in society when we try to hide who really owns what.
Right. What's the feeling underneath the paperwork?
Exactly. So let's just start with a picture. I want you to imagine receiving an unexpected financial windfall.
Like a really significant one.
Yeah, something most of us have daydreamed about, right? Maybe it's a massive, unanticipated bonus at work.
Or, an inheritance from a distant relative, the estate finally settles.
Right, or just a sudden stroke of luck. An investment that just multiplied overnight. You log into your bank account, and the number staring back at you is suddenly substantially larger.
It's a shock. A literal physiological shock.
Yes. Notice that immediate, almost biological instinct that follows the discovery.
It's so fast. Before you even feel joy or, start planning what to buy, there's this sudden, sharp contraction.
A contraction. That's the perfect word for it. Your immediate impulse is not to broadcast this new reality.
No, it's to camouflage it.
To stay quiet. To just close the blinds on your financial life.
And if you've ever experienced this, you know exactly what that feels like.
You're sitting there with this new reality, and you are immediately calculating, running a silent ledger in your head.
Who am I going to tell?
Right. And more importantly, who will I absolutely not tell?
Which is usually a much longer list.
It is. And, you might justify it to yourself as modesty. I don't want to brag.
Or I just want to avoid any awkwardness with my siblings or, my coworkers.
Sure, perfectly reasonable justifications.
Mm-hmm.
But underneath those, there is a quiet separation happening.
You're building a wall, brick by brick.
You really are. And I always think of it imagine holding a rare, incredibly fragile glass sculpture.
Okay, I like this.
But you're holding it in the middle of a super crowded, bustling room, like a busy party.
Right, people bumping into you.
Exactly. Your first instinct isn't to hold this priceless thing up to the light and show it off to everyone.
Oh, definitely not. The friction of that crowd is way too dangerous.
Right. Your instinct is to just slip it into your coat pocket.
Somewhere safe.
Yeah, where no one can accidentally knock it out of your hands, and honestly, where no one can ask to hold it.
You just want it secured. And invisible.
Totally invisible.
And think about the alternative in that crowded room. If everyone sees the glass sculpture, the whole dynamic of the room changes instantly.
People start acting differently toward you.
Exactly. Some might be super careful around you, others might get a little envious, but the baseline reality is that your relationships in that room are irrevocably altered by that asset.
So the coat pocket is basically a way to maintain the illusion that nothing has changed.
It's a preservation mechanism. You acquire an advantage, and your immediate response is to secure the perimeter.
Wow. Secure the perimeter.
And it's not a learned behavior from reading the Wall Street Journal. It's an instinctual, universal human response.
But, and this is where it gets wild, let's push that analogy further. Because today, we aren't just talking about a single bonus or a glass sculpture.
No, we're looking at global finance.
Right. We're looking at international legislative frameworks. So what happens when that exact same human instinct is scaled up?
Well, you can't fit $1 billion corporate asset into a coat pocket.
No. Or a sprawling international real estate portfolio.
So the coat pocket has to become an entire architecture of invisibility.
An architecture of invisibility.
Yeah, that simple, quiet instinct to hide a bonus. It evolves into a global system of cross-border legal entities, trusts, and armies of professionals.
But the root impulse is the exact same.
The exact same. The fear of the crowded room.
Okay, so let's name this idea, because in the world of global finance, this architecture has a very specific name, right?
It does. Broadly, we're talking about financial secrecy. Or, in the language of the FATF, the Financial Action Task Force, it's the concealment of beneficial ownership.
Okay, before we dive into the FATF reports and all the data, we really need to establish the vocabulary here.
Definitely. It's the foundation for everything we're going to discuss.
So let's start with beneficial owner. We hear this thrown around in the news a lot, but what does it technically mean?
So a beneficial owner is the natural, living, breathing human being who ultimately owns, controls, or benefits from an asset.
A living, breathing person.
Right. It's the person who gets to spend the money or live in the house or call the shots for a company.
Okay.
And this is crucial. A beneficial owner cannot be a company. It cannot be a trust. It has to be a human being with a heartbeat.
Even if their name is literally nowhere on the paperwork.
Exactly. Even if their name is nowhere on the property deed or the bank account, if they're the one pulling the strings and reaping the rewards, they are the beneficial owner.
So they are the actual human at the very end of the paper trail.
Right. But as you said, the paperwork rarely shows their name.
Which brings us to the counterweight, what the FATF calls legal persons and legal arrangements.
Yes. To understand how financial secrecy works, we have to understand how the law treats non-human entities.
Right, because a company isn't a person.
Well, legally, it kind of is. Legal persons are entities like corporations, LLCs, partnerships,
Okay.
and legal arrangements are constructs like express trusts or foundations. These aren't human beings, but the legal system grants them the ability to act as if they are.
Wait, meaning they can do things a person can do.
Exactly. They can own property, open bank accounts, they can sue someone, they can be sued, they sign binding contracts.
So they are the official visible owners on paper.
They are.
Let me make sure we define express trusts and foundations clearly for you listening, because those aren't really everyday concepts for most of us.
Sure.
If a corporation is a company doing business, what exactly is an express trust in this context?
So an express trust is basically a legal relationship. It's created by a person called the settlor, who puts assets under the control of someone else.
The trustee.
Right.
Yeah.
Trustee. And they hold it for the benefit of a third party, the beneficiary.
Okay, so there are three roles.
Yes. And the critical mechanism here is the splitting of ownership. The trustee holds the legal title. To the outside world, the trustee owns the house or the money.
But they don't get to use it.
Exactly. The beneficiary holds the equitable title. They are the ones who actually get the money.
Oh, wow. So ownership is literally split in half.
It is. And a foundation operates similarly in a lot of civil law countries. It's a legal entity set up to hold assets entirely separate from the person who originally funded it.
Okay, so the core dynamic we're exploring today, this financial secrecy, is basically the physical and legal space between those two concepts.
That's exactly it.
It's the distance between the legal owner on the paperwork and the beneficial owner sitting in reality.
The deliberate engineered distancing of a person from their wealth.
It's like sending a proxy to a meeting.
Oh, that's a great way to look at it.
Yeah, think of it like you send a proxy to a really high-stakes negotiation. The proxy is the legal person. They show up in the tailored suit, they sit at the mahogany table, they sign the documents.
They're the face of it.
Right. To everyone in the room, the proxy is the one in charge. But you, the beneficial owner, you're sitting comfortably at home in your living room.
Wearing a hidden earpiece.
Yes, wearing an earpiece, listening to every single word, and quietly telling the proxy exactly what to say and do.
You hold all the power, but you assume absolutely none of the visible presence.
So that separation, that proxy, that's the foundation of it all.
It's a foundation of basic everyday privacy, but also the most complex systemic concealment operations on the planet.
Okay, so we've named the idea financial secrecy. We understand the legal separation, but I really want to bring in the science here.
Yes, the behavioral aspect is fascinating.
Because this isn't just a legal loophole that lawyers dreamed up. Behavioral scientists have actually studied how we act when we acquire an advantage.
Right, the University of Exeter study.
Yes, from their business school. Specifically, research led by Dr. Jingnan Chen. They ran some incredible experiments to observe how human beings actually behave when they have a financial edge.
And exactly how secrecy plays into that behavior.
So talk to us about the methodology, because how they set this up is what makes it so revealing.
Well, they didn't just hand out surveys asking people how they felt about money.
Right, people lie on surveys.
Exactly. They put people into an environment where their actual behavior could be measured. They used a classic behavioral economics setup.
The public good game, right?
Yes. So they put participants into groups of 4. In this game, each person receives a certain amount of earnings, and they have a choice. How much of their own private money do they want to contribute to a shared public pot?
And just to clarify the mechanics of this for you listening, whatever money gets put into that shared public pot by the group, the researchers multiply it.
Right. They simulate a return on investment.
And the multiplied amount is divided equally among everyone in the group of 4, regardless of who actually contributed what.
Exactly. It's a microcosm of society. It mimics workplace cooperation or, paying taxes for a community project.
Because if everyone contributes everything they have, the multiplier effect kicks in and the whole group gets significantly richer.
But there's always the temptation of the free ride.
Oh, right.
You can keep all your private money safely in your own account, contribute 0, and still collect your equal share of whatever the other 3 people put in.
Which is such a deeply human dilemma. But Dr. Chen and her team introduced a variable that completely changes this dynamic.
Yes, they didn't give everyone the same starting amount.
Right. They artificially created inequality right out of the gate. Some players were given an income advantage.
And they varied how that advantage was acquired, which is key. Sometimes the players earned it through pure skill, like solving a puzzle faster than the others.
Okay.
Other times, the advantage was entirely arbitrary, a mix of skill and pure blind luck.
So you have a society of 4 people, and some are just richer than others before the game even starts.
Exactly.
But wait, let me play devil's advocate here. Is there really a connection between hiding a luck-based advantage in a lab game and, legally minimizing your tax burden using international law? Does that translate?
I mean, obviously, the scale and the legality are entirely different, but the underlying psychological driver, the friction avoidance, it's identical.
The friction avoidance.
Yeah. The researchers wanted to see what the advantage players would do with their extra wealth. Would they contribute proportionally more to the shared pot, recognizing they had an edge?
Or would they hoard it?
Right. And the findings were staggering. It completely confirms that human picture we painted earlier with the coat pocket.
Because the advantage players didn't just quietly sit on their wealth.
No. They were actually willing to pay money out of their own pockets to hide their luck-based edge from the rest of the group.
Wait, let me make sure we really absorb the weight of that. People will actively spend their resources. They will intentionally make themselves slightly poorer just to ensure that others do not know they have an advantage.
Yes. They are literally buying the coat to hide the glass sculpture.
Wow. They incur a tangible financial cost to purchase secrecy.
The urge to conceal is that powerful. The data shows that when people have an advantage, particularly one that involves luck or arbitrary circumstance, they anticipate resentment.
Oh, they know the group is going to look at them differently.
Exactly. They anticipate the group will naturally expect them to carry a heavier load, to contribute more, and to avoid that social pressure, to protect their unequal share, they buy a curtain to hide behind.
And the macro effect of that curtain in the game is devastating, right?
It is. Because of this purchase secrecy, the pre-existing income gaps within those groups actually grew over time.
The secrecy allowed the advantage to just hoard their edge without facing any social pressure to balance the scales.
The rich got richer, quietly.
But the Exeter researchers didn't just diagnose this, they tested an antidote.
They did. They wanted to see what happens when you force transparency, when you alter the environment.
So they ran a second experiment where the curtain was completely removed. Everyone's earnings were made public to the rest of the group.
You couldn't hide your advantage, no matter how much you were willing to pay.
But the data here is deeply counterintuitive. Transparency alone wasn't enough.
Right. If people could see you were hoarding your wealth, but they couldn't actually do anything about it, the hoarding just continued.
So just turning the lights on didn't fix it.
No. Openness only resulted in a massive increase in cooperation and fairness when it was combined with one specific mechanism.
Accountability.
Accountability. The researchers gave the peers the ability to penalize those who were being selfish.
So transparency without accountability did nothing.
Exactly. But when openness was combined with a penalty for maintaining that financial secrecy, suddenly the advantage players adapted. They started contributing fairly.
It requires both, the light being turned on and the rules being enforced.
It's a profound realization about human nature. Our instinct to hide is deeply responsive to our environment. If the system allows secrecy, we will seek it, even at a cost.
But if the system demands openness and ties consequences to it, our survival instinct shifts from concealment to cooperation.
Exactly.
So, okay, we've established the psychological baseline. The Exeter study proves our individual reflexive urge to hide an advantage.
And our willingness to pay for it.
Right. But how does this translate into the wild? If I have that instinct, and I'm a multinational corporation or a high net worth individual, I'm not just putting the money in my pocket, I'm industrializing the secret.
Yes, you are building a very tall wall.
So let's look at the patterns. How do people actually build these walls on a global scale?
Well, to understand the global scale, we really have to look at the architects of the walls.
The enablers.
Right. The FATF and Egmont Group reports focus heavily on these professional intermediaries, the hidden gatekeepers.
We're talking about lawyers, accountants, financial advisors.
And trust and company service providers, TCSPs. These are the people who actually draft the complex paperwork. They incorporate the legal entities across various jurisdictions.
Because you can't build a billion-dollar fortress by yourself.
No, you need structural engineers. You need people who know how to navigate the compliance required to open international bank accounts.
And what the financial intelligence data reveals is that these professional enablers, they exist on a spectrum of complicity.
It's not a simple binary of, like, legitimate professionals on one side and shadowy criminals on the other. The FATF categorizes them based on their awareness and their intent.
Right. So at the baseline, you have the unwitting professionals.
These are the people who are simply missing the red flags. They're processing paperwork, filing incorporation documents, and they genuinely do not realize they are part of a massive concealment scheme.
Because the scheme is compartmentalized.
Exactly. They only see one small, seemingly legitimate piece of the puzzle.
But the data takes that a step further into a category I find psychologically fascinating, the willfully blind.
Yeah.
Let's debate the line between unwitting and willfully blind, because the legal implications there are massive.
They really are. The willfully blind professional is presented with red flags,
Yeah.
but actively chooses to ignore them.
Like a client comes in with a bizarre, overly complicated request that makes absolutely no commercial sense.
Right. And the professional asks no further questions. They complete the isolated transaction, they collect their fee, and they intentionally avoid acquiring actual knowledge of the broader strategy.
They are preserving their plausible deniability.
Exactly. They're basically saying, it is not my job to audit my client's intentions.
It's engineered ignorance.
It is. And then, at the far end of the spectrum, you have the complicit enablers.
True architects.
Yes. These professionals have actual documented knowledge of the criminality or the concealment. They aren't just filing paperwork, they're actively structuring the complex corporate opacity.
They're brainstorming the best jurisdictions to hide the beneficial owner.
They're building the maze.
Okay, so let's explore the actual mechanics of that maze. If I am sitting here with an immense financial advantage that I want to conceal, and I hire a complicit architect, what are the specific tools we're going to use?
Well, the FATF and sources like FIO's compliance map out these specific methods meticulously. There are 3 primary tools that form the foundation of almost every major scheme.
Okay, let's go through them.
The first, and definitely the most infamous, is the shell company.
A term we hear constantly, but let's define the actual plumbing of it.
Right. For the purpose of these concealment schemes, a shell company is an entity that is legally incorporated. It exists on paper, but it has no independent economic reality.
Meaning no physical operations.
No operations. No significant assets other than the funds it's holding. No ongoing business activities. No employees.
It's purely a legal vessel designed to hold title to an asset.
It's a ghost ship. It has a name, it has a registration number, but no crew and no cargo other than a bank account.
The ghost ship. Okay, what's the second tool?
The second tool is the use of nominee directors and nominee shareholders. This is that human proxy we discussed earlier.
Right.
A nominee is an individual whose sole function is to put their name on the corporate paperwork in place of the beneficial owner.
And the data shows this takes a few different forms, right? It isn't always a professional firm providing the nominee.
No, it varies widely. A complicit firm might provide a professional straw man, someone who acts as a director for hundreds of different shell companies for a fee.
But often it's much more informal.
Exactly. The beneficial owner might just use a spouse, a child, an elderly parent, or an associate to hold the shares.
But they have no actual power.
None. They have no power to make decisions. They just provide the necessary signature to satisfy the corporate registry.
Okay, and the third tool, this is where the plumbing gets truly complicated.
Complex routing. Yeah. Complex routing is the deliberate creation of transaction chains and corporate structures that defy basic commercial logic. Think about it. If the easiest, most cost-effective way to send money from point A to point B is a straight line.
Complex routing intentionally avoids the straight line.
Entirely.
It's the three-card Monte of global finance. The ball is moving so fast and under so many different cups that the auditor's eyes just cannot track it.
Exactly. The money leaves point A, moves to a shell company in point C, is transferred into a trust in point D, is perhaps converted into a different currency, or used to purchase a temporary asset at point E.
And finally lands at point B.
Right. And the friction, the fees incurred by all these transfers, that's the price the beneficial owner pays for the secrecy. The complexity is the entire point.
It's designed to exhaust the resources of anyone trying to follow the trail.
Yes.
I want to make this tangible for you listening, because we're talking about these concepts in the abstract, but the FATF report details actual historical case studies where these patterns were deployed in the real world.
And seeing them in action is wild.
It really is. Let's look at the granular mechanics of these schemes. I want to start with Case 46, out of Italy. I call this one the trust loophole.
Oh, this case is a masterclass in complex routing and the misuse of legal arrangements across multiple jurisdictions.
So set the stage for us.
Okay, in this scenario, an individual, let's refer to him as Mr. X, was systematically and illegally diverting massive amounts of funds from an Italian company that he managed.
So he's stealing from his own company.
Basically, yes.
Yeah.
And to launder this money and conceal his beneficial ownership of the stolen funds, he employed a UK law firm to architect a solution.
Okay, follow this chain carefully because the jurisdictional arbitrage here is staggering. The scheme begins with the creation of an Irish company.
Right.
But Mr. X doesn't own the Irish company on paper. The Irish company is 100% owned by a company incorporated in the British Virgin Islands, or the BVI.
Yes.
And the BVI company, in turn, owns 100% of a Luxembourg company. So we have an operating chain spanning Ireland, the BVI, and Luxembourg.
And consider the why of those specific jurisdictions. They aren't chosen at random.
No.
Luxembourg has historically had very specific rules regarding corporate invoicing and taxation. The BVI is notoriously utilized for its corporate registry privacy, making it incredibly difficult to see who's behind a company.
And Ireland provides a robust, seemingly traditional corporate environment, so the architects are stacking different legal environments to create maximum opacity.
Exactly.
So how does the money actually move through this stack?
The operational mechanism relies on the Luxembourg company. This entity would receive the diverted money from the Italian company under the guise of fictitious sales.
Let's pause and explain fictitious sales, because this is how the paper trail is falsified. They don't just wire the money and say, here you go.
No, it has to look legitimate to an Italian auditor. So the Luxembourg company generates completely fabricated invoices for services or goods that were never actually delivered to the Italian company.
Like consultancy fees, licensing rights, administrative services.
Exactly. And the Italian company pays these fake invoices, effectively bleeding its own capital into the Luxembourg shell company.
So the money is now in Luxembourg. But who ultimately controls it? Because this is where the trust comes in. The shares of that original Irish company, the one at the top of the chain, were not held by Mr. X.
No, they were held in a trust.
And that trust was set up specifically for the benefit of Mr. X's son.
Yes. And furthermore, the trust itself was managed by a professional trust service provider located in Jersey.
Which was connected back to the original UK law firm that designed the whole scheme.
The structural density is exhausting just to describe.
It really is. The Italian money flows to Luxembourg, which is owned by the BVI, which is owned by Ireland, whose shares are held in a trust governed by the laws of Jersey for the ultimate benefit of a child back in Italy.
Right. And the only point of this entire international labyrinth is to sever the visible legal tie between the stolen Italian funds and the human being pulling the strings, Mr. X.
It is designed to make the regulatory X-ray machine fail.
Completely fail. And it highlights how legal persons, the companies in Lux, BVI in Ireland, and legal arrangements, the trust in Jersey, are combined to form a nearly impenetrable wall.
Wow. Okay, let's look at another pattern. Case 101 from the United States. This highlights a different mechanism entirely. Inflated asset sales and self-dealing.
Right, the off-market sale. This one feels less like an international spy novel and more like brute force real estate manipulation.
It's highly tactical.
Very. In this case, a single individual controlled multiple legal entities, various LLCs and corporations.
Okay.
The scheme involved taking a commercial property owned by one of his entities
Yeah.
and selling it to another entity that he also secretly controlled.
So he's basically selling a commercial building from his left hand to his right hand.
Yes.
But why? What is the advantage of selling something to yourself?
The advantage is the artificial inflation of value. When he sells the property to his other entity, he sets a highly elevated, completely fabricated purchase price, far above the actual market value of the building. And to finance this fake inflated purchase, the buying entity submits massive loan applications to banks.
Ah. And to convince the banks that this inflated price is justified, the individual has to manipulate the paper trail again.
Exactly. He submits fraudulent appraisals. He systematically alters invoices from construction companies to make it appear as though massive, multi-million-dollar improvements had been made to the property.
He creates a dense, seemingly legitimate paper trail of property upgrades, high-value sales, and corporate loans.
Right. The legal persons, the LLCs, are interacting with each other, generating a blizzard of paperwork.
But the beneficial owner is the exact same human being, sitting on both sides of the transaction, quietly pocketing the excess loan money.
It is a closed loop of fiction.
A closed loop of fiction.
All right.
Which brings us to Case 106, originating from the Vatican.
This one is fascinating.
It involves a financial instrument that sounds like an artifact from a bygone era, the bearer share.
I know, it sounds like something from a movie.
I read through the Egmont Group's notes on this, and the bearer share is an incredible instrument of absolute secrecy. It operates completely differently from how we understand normal corporate stock.
It does.
Yeah.
Typically, when you own shares in a company, your name is recorded in a central corporate registry or a shareholder book.
Right. If authorities want to know who owns the company, they subpoena the registry.
Exactly. But a bearer share bypasses this entirely. The share itself is a physical piece of paper, the certificate. And whoever physically holds that piece of paper, the bearer, is the legal owner of the company.
Wait, so there is no central registry? There is no ledger?
None.
If I hand the piece of paper to you, you now own the company, and there's zero digital or paper trail documenting the transfer.
It is the ultimate proxy.
That is wild.
So in this specific Vatican case, authorities were monitoring a politically exposed person, or a PEEP, from South America.
And a PP is someone with a prominent public function, right? Like a politician.
Right. And this individual was already under investigation for severe corruption and money laundering. This PEP was managing a company incorporated in the Caribbean, and this Caribbean company issued bearer shares.
So the ownership is entirely fluid and untraceable.
Yes. And this PP attempts to execute a massive transaction, wiring 1 million euros from an international bank headquarters directly to a charitable entity located in Europe.
How does a bank even process a transaction when the ownership of the sending company is just a piece of paper in someone's briefcase?
That is exactly where the AML anti-money laundering checks failed, or rather, where they caught the scheme. The charity, commendably, refused the transaction.
Oh, good for them.
Yeah. They could not verify the source of the funds or the true beneficial owner behind the Caribbean company, and they flagged the attempted wire as highly suspicious to the authorities.
And the telltale pattern here is what happened next, the reaction to being caught.
Right. Immediately after the transfer was denied and scrutiny was applied, the Caribbean company was completely dissolved.
It just vanished.
Vanished. The use of bearer shares to maintain total anonymity, followed by the sudden, immediate dissolution of the corporate entity the moment the wall was breached, it is the textbook footprint of concealment.
These cases represent massive millions of dollars operations, but the FATF report makes a crucial point. The gatekeepers and authorities who catch these schemes rarely uncover the entire labyrinth on day one.
No, they notice what they call indicators.
The quiet red flags that signal a discrepancy between the paper reality and the human reality.
And the indicators are deeply rooted in basic human behavior and practical logistics. For example, a massive red flag is a client's severe reluctance to provide basic personal information.
Or an inability to clearly explain the business history of their own company.
Exactly. Like, if a company was incorporated 3 days ago, why does it suddenly have $10 million moving through its operating account?
One of the most glaring indicators detailed in the report is the mismatch of communication tools.
Oh, this one is so common.
You have a multinational corporate entity allegedly conducting complex cross-border business worth tens of millions of euros, but their primary point of contact is a generic Hotmail, Yahoo, or Gmail address.
Right. Another major red flag is the physical footprint, or the lack thereof. An investigator looks up the registered address of a highly profitable international consultancy firm.
And when they check a street-level map, the address resolves to a small suburban residential home.
Or simply a post office box in a strip mall. The physical reality does not support the financial claims.
And then you have the transactional red flags, cyclical transactions.
Yes, this is where money leaves account A, goes to account B, is transferred to account C, and then lands right back in account A, minus a few intermediary transfer fees.
There is no economic rationale for the movement.
None. The money goes in a massive circle and ends up exactly where it started, simply to create a layer of transactional history.
It's like looking at a suburban neighborhood where one house has 10 different mailboxes out front. The curtains are permanently drawn, delivery trucks keep pulling up, dropping off empty boxes, and then an hour later, different trucks arrive just to pick those exact same empty boxes up and drive them away again.
If you just look at the mailboxes and the trucks, it looks like a busy house.
But the behavior itself is the footprint. The pattern reveals the secret.
The behavior is the footprint.
Mm-hmm.
But I think this brings us to a crucial turning point in our exploration.
I agree.
We have spent the last half hour looking at the intricate mechanics, the shell companies, the billions of dollars in diverted funds, and the willful blindness of enablers.
And it is very easy at this point to slip into a place of deep judgment.
It is.
So let's pause our exploration of the plumbing for a moment, because I want to speak directly to you, the listener.
Yeah.
When we hear these terms, Panama Papers, Swiss leaks, offshore tax havens, it is incredibly easy to distance ourselves. We picture shadowy villains sitting in smoke-filled boardrooms.
We think that is them. That is a completely different species of human. That is not me.
And while the scale of a multinational bearer share scheme is vastly different from our daily lives, we need to reframe the core behavior.
Because the architecture of a British Virgin Islands shell company owned by a Luxembourg trust is dizzyingly complex. But the human feeling beneath that architecture,
Yeah.
the emotional driver that forced the architect to draw the blueprints in the first place, is incredibly simple.
It's the exact same feeling from the Exeter study we discussed earlier.
It is the fundamental desire to protect what you have.
It's the fragile object in the coat pocket.
Yes.
This behavior of concealment is not a mechanical flaw in the human machine. It is a deeply ingrained human survival response.
When we feel we have an edge, our instinct is to guard it.
Whether it is keeping quiet about a holiday bonus so a relative doesn't ask for a loan, or a massive corporation using legal professional privilege to shield the identity of a beneficial owner from public scrutiny, the root is the exact same.
It's a fear of vulnerability.
It's the fear of what happens if the world sees what I actually hold.
We build these walls because openness feels dangerous. We fear taxation, yes, but we also fear judgment. We fear the expectations of others.
We fear that if people know what we truly possess, the dynamics of our relationships will irrevocably change.
The global offshore financial system wasn't built by aliens. It was built by human beings acting on a very human anxiety.
So if you have ever felt the urge to obscure your financial reality, if you have ever downplayed your savings in a conversation, or hidden a purchase from a partner, or created a boundary between your money and the outside world, you are not broken.
You are human.
You are experiencing the exact same instinct that built the global offshore financial system. This behavior is something to understand, not something to fix.
It is a mirror reflecting our deepest anxieties about safety and exposure.
Which leads us to a broader systemic question. If concealing wealth is a natural human instinct, an evolutionary survival response, why do organizations like the FATF, the OECD, and governments around the world fight so relentlessly against it?
Why are we dedicating massive international resources to tear down a wall that human nature naturally wants to build?
Let's pull the idea upward. What is the actual societal cost of the wall?
The cost is fundamentally relational, because ultimately, money is never just about money.
It's a proxy.
It is a proxy for trust, for safety, for power, and for belonging. When we build walls around our resources, whether as individuals or as corporations, we do not just protect our assets, we erode the social fabric.
We sever connections.
The Exeter study proved this empirically. Financial secrecy directly exacerbates inequality and destroys cooperation. When the advantaged hide their edge, The shared pot starves, and resentment breeds in the dark.
Secrecy isolates us, and that is why the global frameworks are shifting. We are seeing a massive systemic push for openness at the highest levels of international finance.
We really are.
Let's look at the sources detailing the new legislative tools, specifically the model mandatory disclosure rules for CRS avoidance, outlined by Banking Concepts AG. First, let's define CRS for the listener.
All right, CRS stands for the Common Reporting Standard. It's an information standard for the automatic exchange of information regarding bank accounts on a global level, developed by the OECD.
Essentially, it's a massive international agreement where countries agree to automatically share financial data about each other's citizens to combat tax evasion.
So, if I am a citizen of country A, but I hold a secret bank account in country B, country B's banks are now obligated under CRS to report my account details back to country A.
Okay. But naturally, as soon as CRS was implemented, the architects of secrecy began designing structures specifically to bypass it.
Of course they did, to exploit loopholes in the definitions of beneficial ownership to keep the data hidden.
Which brings us to the new model mandatory disclosure rules. These are fascinating because they target the enablers directly.
Yes. Under these new frameworks, authorities are requiring the intermediaries, the lawyers, the accountants, the TCSPs we discussed earlier, to proactively disclose their schemes within 30 days if they design a structure that is meant to hide assets or bypass CRS reporting.
It is forcing the architects to hand over the blueprints to the authorities the very moment they draw them.
And we are seeing an even more aggressive shift with the rise of Unexplained Wealth Orders, or UWOs, utilized heavily in jurisdictions like the UK.
The legal mechanics of a UWO are fascinating because they entirely flip the traditional presumption of innocence in financial investigations.
They really do. Traditionally, if a government suspects you bought a massive estate with illicit funds, the burden of proof is on the government.
They have to launch an investigation, trace the complex routing, pierce the shell companies, and prove beyond a reasonable doubt that the money was dirty.
Which takes years and millions of dollars.
But an unexplained wealth order changes the math completely.
It forces the individual to explain the math. If your known, legitimately registered income does not match your visible acquired wealth, the state can issue a UWO.
So if you make $80,000 a year on paper, but you suddenly acquire a $10 million property in central London through a BVI shell company, the UWO forces you to pull back the curtain.
You must legally explain how you acquired the asset. If you cannot explain it, or if you refuse to answer, the government can seize the asset.
It is society collectively saying, the walls have gotten too high and the maze has gotten too deep. And we can connect this macro shift in global policy right back to the micro-human experience we started with.
Society is slowly realizing that secrecy divides us. Openness is difficult. It is incredibly uncomfortable, and it goes against our biological instinct to protect our advantage and hide the fragile object.
But it is the only way to build a system and to build relationships that are based on actual fairness and mutual trust. You cannot have a cooperative society if everyone is hiding.
Transparency is not about stripping away privacy for the sake of voyeurism. It is not about knowing everyone's bank balance just to gossip. It is about systemic accountability.
Right.
It is about ensuring that the structures we use to live together, to fund our communities, and to interact with each other are built on a shared reality, not on a foundation of shell companies, fictitious invoices, and proxy earpieces.
So, as we slowly recap the journey we've taken today, we started with that quiet, physiological instinct to hide an unexpected financial win. We named that instinct financial secrecy and the deliberate concealment of beneficial ownership.
We looked at the rigorous science from Exeter that proves we will literally pay money out of our own pockets to protect an advantage and avoid social friction.
We explored the elaborate, dizzying global plumbing built by professional enablers, the ghost ships, the bearer shares, and the 10 empty mailboxes.
And we arrived at the profound realization that all of this, from the hidden bonus to the multi-layered Swiss bank account, is driven by a basic, deeply human fear of exposure.
Consider the walls you have built around your own resources, whatever scale they are on. What is the specific fear that is guarding the gate to that wall?
And what might happen to your life and to your relationships if you allowed just a little more light to shine through?
If this conversation felt true for you,
If something in here landed,
we would love for you to subscribe
to Leone so you never miss.
what we explore next.
Leave a comment and tell us so.
What did this bring up for you?
We read every single one.
We are building a community here.
And people who think about money differently.
not as a number to chase.
but as a human experience to understand.
You are not alone in this.
And we are genuinely glad you are here.
At Leone Patterns. Same pace, same questions. See you then.